Building an emergency fund is crucial for financial stability because it acts as a safety net during unexpected financial setbacks. Here's a detailed explanation of why and how to build one. 2. Build an emergency fund. An emergency fund is a pool of money set aside to cover unplanned expenses or financial emergencies. Life is unpredictable, whether it's a sudden medical expense, car repair, or job loss. Having an emergency fund prevents you from relying on credit cards, loans, or disrupting your long-term savings. Why you need an emergency fund? Financial security. Life is full of unexpected events, and having an emergency fund can prevent you from going into debt when something unplanned happens. Avoid debt. Without an emergency fund, you might have to rely on high-interest credit cards or personal loans to cover unexpected costs. This can quickly lead to debt accumulation. Peace of mind. Knowing that you have a financial cushion reduces stress and anxiety about the unknown. You'll feel more in control of your finances, even during challenging times. Helps with career flexibility. An emergency fund can give you more freedom in your career. For example, if you lose your job or want to change careers, you'll have a buffer to cover your expenses while you search for new opportunities. How much to save in an emergency fund? General recommendation. Most financial experts suggest saving 3 to 6 months worth of living expenses. This means if your monthly expenses, rent, utilities, groceries, etc., total $3,000, you should aim to have $9,000 to $18,000 saved. Higher risk situations. If you have unstable income, freelancers, entrepreneurs, or work in a volatile industry, you may want to save 6 to 12 months of living expenses to provide extra protection. Smaller initial goals. If saving 3 to 6 months expenses feels overwhelming, start with a smaller, more attainable goal. Aim for $500 to $1,000 to cover minor emergencies, and build from there. Steps to build an emergency fund. Calculate monthly expenses. 1. First, determine your essential monthly expenses: rent, mortgage, utilities, groceries, transportation, insurance, and debt payments. 1. These are the costs you would still need to cover in case of an emergency. Set a savings target. 1. Based on your monthly expenses, set a target amount, e.g., 3 to 6 months of expenses. 1. If your monthly expenses are $2,500, your target fund should be between $7,500 and $15,000. Start small and build gradually. 1. Begin by saving whatever you can consistently each month. 1. Even if it's a small amount, the key is to save regularly. 1. Automate transfers from your checking to a savings account to make this process easier. Cut back on non-essentials. 1. Look for areas in your budget where you can cut back to free up more money for your emergency fund. 1. For example, reducing dining out, subscriptions, or shopping. Make it automatic. 1. Set up an automatic transfer to your savings account each time you receive a paycheck. 1. This makes saving easier and ensures you contribute to your fund consistently without having to think about it. Keep it separate. 1. Place your emergency fund in a separate account, ideally in a high-yield savings account. 1. This keeps it accessible when needed but not too easy to dip into for non-emergencies. Replenish when used. 1. If you have to use the emergency fund, make replenishing it a top priority once your situation stabilizes. Where to keep your emergency fund? High-yield savings account. This is ideal for your emergency fund because it's accessible and earns interest over time. Money market account. A money market account often has slightly better interest rates than traditional savings accounts while still offering easy access to your funds. Avoid risky investments. Don't invest your emergency fund in stocks, mutual funds, or other volatile investments. Emergency funds should be liquid, easily accessible, and not subject to market risk. When to use your emergency fund? An emergency fund should only be used for true emergencies, not for discretionary spending. Here are some situations where it's appropriate to dip into your emergency savings. 1. Unexpected medical bills. 2. Car or home repairs. 3. Job loss or significant reduction in income. 4. Urgent travel due to family emergencies. It's important to use the fund wisely and to replenish it after any withdrawals. Benefits of having an emergency fund. 1. Prevents financial setbacks. Instead of taking out loans or maxing out credit cards, an emergency fund allows you to handle unexpected costs without falling into debt. 2. Supports long-term financial goals. By using an emergency fund for crises, you avoid pulling from long-term savings like retirement or investment accounts. 3. Reduces stress. Financial emergencies are stressful, but having a reserve helps you cope with unexpected situations calmly and confidently. By consistently building an emergency fund, you'll create a financial safety net that offers stability and peace of mind. Would you like suggestions on how to start saving effectively, or where to open a high-yield savings account?